Well, tech, of course, as we mentioned, leading today, a sell-off. Shares of Apple, for instance, sinking more than 6% today alone, down over 18% since hitting an all-time high just last Wednesday. For more on the space, let's bring in Jefferies tech specialist, Jared Weisfeld. Jared, always great to get your perspective. Apple has lost about $325 billion in market capitalization in the past 3 days alone. Put that in perspective for us. How much is that in terms of maybe Apple's revenues or lines of business, et cetera?
Absolutely. Thanks for having me on again. So, I mean, in general, if you think about the market cap loss over the last 3 days for Apple, as you mentioned, it's about $325 billion. To help put in perspective, that's about 1.5 times Salesforce.com. That's the equivalent to Apple's projected revenues for next calendar year. It's a significant amount of market cap that has been lost. And I think this goes to speak to what Dan and Tim were just mentioning in terms of just the overextended nature of the rally that we just observed. When you look at the breadth outside of large cap tech, outside of FANG, it was really poor heading into this. So I think this is very consistent with the conversation that you've been having earlier in terms of, I certainly haven't sensed any panic from clients or investors that I've spoken with over the last couple of days. I think the Fed put is very real. They're not going anywhere. The 210 spread in terms of the yield curve is very steady at about 50 basis points. So I think it's, to the extent that you're starting to see some of this Robinhood margin call work its way through the system, I think that could absolutely be part of it as well. But no doubt about it, the large cap tech has let us lower, and today's action was certainly dramatic, evidenced by Apple dropping below the $2 trillion market cap.
Hey, Jared, it's Dan. Quick one for you. A week ago today, we were on this program trying to explain to viewers why Zoom had just gained $40 billion in market cap in one day, 40% higher in one day. Now, it's nearly filled in that entire gap since its extraordinary earnings. How do you put that in some sort of context in just 1 week of market action, a name that obviously has come to just embody much of the euphoria that exists in this NASDAQ? But it's a pretty peculiar situation here, and I suspect fundamental people were not getting into the name a week ago Friday on the long side.
I think that's exactly right, and it's a bizarre situation that you're seeing across the space. I certainly had many conversations on Zoom after the earnings print with many clearly not prepared for an up 40% move on a well-anticipated, better than expected set of results. But I think a lot of this goes into this interplay between value and growth that we've been observing here over the last few weeks. Many that I've spoken with, and I'm certainly of this view as you think about the rotation from work from home beneficiaries into value when you're preparing portfolios for post-COVID recessionary conditions or any type of recovery conditions, rather. Like, what do you want to be owning on the other side of this? I thought today's market action was telling in that you saw shares of Disney, you saw shares of the ride-sharing companies, and even Lyft gave a positive update after hours. This transition into what to own in a post-COVID recovery, what makes that top of the list? And I would agree with you in terms of the bizarre reaction in Zoom, but it's not specific to Zoom. And I think it's partly Robinhood, but I think more importantly, it's partly in zero interest rate environment that we're in. When you think about the impact that ZIRP is having, look at Salesforce.com after their print. Salesforce obviously had a fantastic print, but to put things in perspective, all they did was reinstate a guidance that they had pre-COVID, and they reinstated 75% of that guidance. And despite that, the shares were up 25% after being added to the Dow the day before. So it's not idiosyncratic to Zoom, and we're seeing that all across tech.
Hey, Jared, it's Tim. So I know you're not dismissing these moves. Again, these were extraordinary moves higher, but you're explaining them in the context of the moves they made. What would be another indicator, or what else are you watching from a chart perspective that would tell you this move is widening out? And this isn't just about overbought tech stocks. And frankly, we've seen rotation back and forth, even though it seems to have been a one-way trick for NASDAQ only. I mean, is it a dollar move? Is it something, a breakdown really that much more in a FedEx or some of these names that have held up there? What are you watching?
So I think from a NASDAQ perspective, something to keep in mind, we actually hit the 50-day on the support chart today. So I do think it's encouraging that perhaps we're going to get that flush that we're all looking for as NASDAQ's going to hold for dear life here at the 50-day. In terms of just trying to better understand where money flows are going to go next, I do think I want to take a look at how when you think about, in line with the commentary that I mentioned before with respect to what to own on the other side of this, I mean, I think it's a very plausible explanation that on the next move higher from a market standpoint, could it be outside of tech? When you think about the fact that if we're going to go ahead and recover, and God forbid the yield curve does steepen and economic conditions do get better, do you want to own more pro-cyclical names outside into industrials and energy and financials, and do some of the names that that we're talking about here that are sporting punchy valuations that benefited from work from home? Do they take a little bit of a breather? So I'm watching the yield curve, I'm watching industrials, and I'm watching sort of the interplay between value and growth.
Jared, great to speak with you. Thanks for your thoughts. Always appreciated.
Thanks.
Jared Weisfeld of Jefferies. Guy Adami, what does the Guy Adami post-COVID world portfolio look like?
Yeah, it's a fascinating question. I don't know when, I don't know if we are post-COVID or how close we are to being post-COVID. We're getting into a season now where obviously we're going to overlap with the flu. I don't think we've ever got out of the first wave. So I don't know. What I said last week was that it's interesting. The airlines were up today. And one of the comments we made late last week was maybe the worst is over in terms of the stocks. I don't think the worst is over in terms of the environment out there, but maybe the stocks have priced it in. The banks I thought would be part of the play, but clearly on a day like today, when they give up the ghost like that, you have to be concerned. And oh, by the way, something we didn't mention, but it's worth mentioning, don't discount the fact that these U.S.-China relations aren't getting any better. As a matter of fact, they're getting worse. And I think for the first time in a while, maybe the stock market is pricing that in. So there are a lot of things to be concerned about out there. But these things were existent, the entire move up. So I'm not breaking any ground here, Mel.
Yeah, and by the way, no stimulus package still. So yet another thing weighing on stocks here.